Welcome along to the Squirrel Investor webinar today. The webinar invite goes out to all our existing investors, and it's a chance to ask any questions that you have along the way, and I'll present some information up front. As we go through the first part of the presentation, which should take us around about 20 minutes, you can click on the Q&A button on the bottom of your Zoom screen, and you can pop any questions you like in there, and I'll get to those at the end. So there's about 20 minutes of me talking to those bullet points that you can see on the left-hand side of your screen, and then we'll get into the Q&A part. Righto, without further ado, today's content, we're going to start with the housing market. And to lead us into that, I've actually got a couple of slides which show some economic data. So let's rip into that first of all. Pausing briefly, this data comes from the Reserve Bank and it shows the volume of retail trade activity in the economy. The two big orange arrows there give you an indication of what happened during the GFC and where we're at today. So you can actually see from that perspective, the economic activity in New Zealand right now is actually pretty weak. It feels very different to the GFC, but the activity is definitely down. So keep that one in mind. A very busy looking graph, this one, but once again, I'll point you to the two orange arrows. So the arrow on the left is what happened to manufacturing during the GFC. You can see that dropped away dramatically during 2008, 2009 period, and the yellow line there talks to employment. That level of employment obviously dropped significantly during that period. And if you shoot forward to what's happened today, you can see that production is definitely falling. And it's the lowest that it's been outside of any lockdown periods that you can see all that noise in the graph since the GFC. And equally, unemployment also rising, level of employment falling. However, there's been a big surge in migration. So the yellow line that you can see on this graph tracks the net growth in people that actually live here in New Zealand. So really strong migration impulses kicked into gear. So what does all that mean then for the housing market? So if you look at prices, so that's the graph on the left, you can see prices were falling during sort of from late 21 through to about March, April this year. Since then, we've seen prices perhaps bounce off the bottom a little bit, not a huge amount. Broadly speaking, I would say prices are pretty flat at the moment. And I wouldn't say there's any sign of that changing in the next few months. Hard to look beyond that. But for now, no signs of surging prices. From a housing turnover perspective, if you look at the graph on the right-hand side, the dark blue line is the volume of houses turning over in New Zealand each month. And if you look at where that line is at the moment, you'd say it's below average. There's definitely been a pause in the run-up to the election, and our Squirrel mortgage advisors have definitely seen that. However, if driving around, certainly around Auckland at the moment, there is a lot of houses that have just come back onto the market or come onto the market recently. So we're expecting activity to actually pick up and slightly higher turnover in the foreseeable future. There's been some market commentary about house prices taking off over the next wee while. I'm not certain that that's going to occur. There is too much tightness in the economy. There's not enough cash flow. Despite all those migrants coming into New Zealand or new migrants arriving in New Zealand, the will and the ability to purchase just aren't there with interest rates where they're at right now. So I don't expect we're going to see massive increases in house prices anytime soon. It's just going to bumble along the bottom of where it is today would be my expectation in the foreseeable future. So let's talk through to the next 3, 4, 5 months in that zone. Beyond that, who knows? Certainly new government has some more investor-friendly policies that they're likely to roll out. So that may stimulate that investment property market to kick back into gear a little from where it is today. All right, so that's the roundup of the housing market in a few short slides. Next topic for today is interest rates. So this is looking back over the last 12 months, what's happened to wholesale interest rates. So I've picked a 1-year wholesale swap rate, and this is a daily chart of what that rate was on any particular day. What you can see, broadly speaking, is that rates were rising up until about the middle of this year. And from that point, they've been flat and in more recent times have started to fall. So if you look at that economic picture that I talked to in those first couple of slides in today's webinar, things are looking a little grim economically, and interest rates are starting to respond to that. So you're seeing that wholesale interest rates starting to fall. That hasn't translated into retail interest rates just yet, and I'll cover that a bit more in a second. This data comes from the Reserve Bank and tracks the average home loan rate that's being paid by people in the market. It's not the new rate today, it's all the existing home loans. What's the average home loan rate that people are on? So that's the yellow line that you can see on that graph. And you can see it rising pretty steeply. At the moment, it's around 5.5%. I suspect that's got some more legs to run and is going to get up close to the top of this graph, up near 7%. Over the next wee while. Somewhere between 6 and 7% is probably where it's going to top out at, based on where retail interest rates are today. So this is probably another 4, 5, 6 months worth of pain of rising interest rates before we really see those rates starting to come back. The blue line on this graph is the cost of bank deposits. So if you look at all of the deposits that banks hold, they pay no interest on some of those deposits. So if there's money sitting in a transaction account, they pay some on money sitting in a savings account, and the highest rates on term investments. So if you add all of those together, the average rate that banks are paying today on their existing portfolio of deposits is around 4%. This data was cut at the end of September. We don't have October's data yet. That's probably due towards the end of this week. What you can see, though, is that blue line starting to tip over and look like it's starting to reach a top, which is what we'd expect to happen. If you look at that, the grey line on this graph, that's the 1-year swap rate. So it's the wholesale interest rate for 1 year. You can see that's also reached its top in September. And if you go back to that graph on the page prior, it's tipped over that edge now and is starting to drop. It takes a while for retail rates to respond to the movements in wholesale markets for a range of reasons. So how does that play out for Squirrel? This was a question that I got from 2 investors over the last couple of weeks when I said I was running the webinar and asked for any views on things people wanted to talk about. So this was one of the things that popped up. So what we show on this graph is Squirrel's interest rates, term investment interest rates for our home loan and construction loan term investments, which are the orange and green lines respectively. The black line is the bank's 6-month term investment rate. Now, I've chosen the bank's 6-month term investment rate because that was the data that was easily available from the Reserve Bank. So that's the rate that's on offer on average from the banks for that 6-month period. And you get specials, obviously, at 12 months or 18 months or 15 months or 9 months and all over the shop. So it's not perfectly reflective of what the rates are that are available to you right now, but it's indicative of how rates have trended over time. You can see we obviously went through that very low point of interest rates during the COVID period. It's recovered from there, and we've seen the gap between Squirrel's interest rates and bank interest rates close up. Partly that's because we're at the top of the cycle. So I would say if I roll this forward about 6 to 9 months, you'll start to see the grey line and the black line are going to tip over and start heading back down. The Squirrel interest rates are likely to head down once there's an OCR cut. So if you believe what bank economists are saying, and they're looking ahead and saying that somewhere between the middle to late 2024 is when we'll see the OCR starting to fall, that's the point where you can expect Squirrel interest rates likely to come off at that point. So you're likely to see bank 6-month term investment rates and that 1-year swap rate head down before you see the Squirrel interest rates fall, albeit that gap has closed up. The next obvious question I think that comes off the back of this is, well, how much risk am I taking with Squirrel versus a bank? So very hard to contrast and compare. Banks, obviously very large institutions. They have a much greater diversity in risk than what Squirrel does. However, what we can do is measure Squirrel's credit risk profile, and we can measure that in a percentage way. So if we look back over time, I've presented Squirrel's construction loan and home loan portfolios credit risk. You can see the orange line, which represents our home loan credit risk, has remained relatively stable around 10 basis points over the last few years. For the construction loans, you can see that it's actually fallen by a reasonable amount over time. So Squirrel made some deliberate decisions back in May 2022 to reduce the amount of risk that we had in that portfolio. And that comes through in a few different ways. So, for example, the loan to value ratio that we might offer a borrower might be lower than what it was before. So over time, as some of the older loans have worked their way out of the portfolio and the newer loans written at lower levels of credit risk have come onto the portfolio, you can see that the average credit risk in the portfolio has been falling now for some time, and is probably stabilizing between 0.3% and 0.4%. We're very comfortable at that rate. And key thing with credit risk is we have our reserve funds that are sitting alongside that credit risk to help manage it. So in those reserve funds, you can see in the table on the right-hand side of the slide, you can see the absolute size of the reserve funds relative to the size of the portfolios. And those reserve funds are in a very healthy position. For those of you investing in personal loans, you would have seen the announcement we made about 6 weeks ago, which saw you get an increase in your investor interest rate, as the reserve funds are in a very mature, strong position to handle the amount of credit risk in that portfolio. For home loans and for construction loans, we're continuing to reserve at very conservative rates. We want to see those funds grow or continue to grow. No particular concerns, they're in a healthy state, but the portfolios are growing relatively quickly, so we want to make sure that the reserve funds are growing in line with that. All right, whirlwind, keep on tracking. So new features, some new things coming into for investors. So first of all, you may have noticed that when you now place an investment order, that will match in less than 60 seconds. So that's live. That went live about 3 weeks ago. So you see a much faster investing experience in place. When you place the investment, it'll match within 60 seconds, and either the investment will have started, it will have joined the queue of other investors in the case of personal loans, or in the event of where the underlying loan that you've matched to has had a credit event, you'll be notified of that and asked then to make a decision. I'm going to cover that last little bit that I just said in a bit more detail after this. But key thing is, when you place an investment order, you should see that match inside 60 seconds. Second point here, we've got a new updated user experience arriving for you. Updated screens and layout will arrive for desktop users next week, likely Monday, but we'll give ourselves a bit of wriggle room. So sometime next week, you'll see that user experience change and improve, we believe. So clearer layout for information, things are easier to find. The screenshot that we've got on the right-hand side of the slide here shows you what the mobile version is likely to look like. We're still putting the finishing touches on that, and that's going to roll out mid to late January. So excited to get this out the door. We've been working on it for some time. And this also, this new layout and things sets us up for a new feature, which will be multiple on-call accounts available and allowing you to separate your investments into different buckets. So that's likely to arrive in March 2024. We're working on the designs of that right now. And you should see, we've worked with a few investors. So there's a handful of investors that we've worked with and helping us refine those designs. And we're probably going to finalize those in the next week or two, and then get into building out that capability, which you'll see us hopefully in market by around March. So that's some of the new features that you've got coming. A reminder, next week, you're going to see a new layout arriving for those on desktop. And that same layout is going to apply to mobile, and that's coming mid to late January. All right, I promised to talk about accepting and declining term investment offers. This was I had a couple of requests for this one as well from investors over the last couple of weeks. So I talked about when you place a term investment order, it will automatically start within 60 seconds, assuming there are investments available. If the loan that you match to has had a credit event, or where it's a personal loan, if the interest rate you're being offered might vary from what is the prevailing rate, then you're presented with an offer to accept or decline. If you do nothing, so if you either miss the message coming through or you ignore it, it will lapse within 24 hours and your investment order will then match the next available loan at that point. A reminder here that all the investments that you're offered will have the backing of Squirrel's reserve fund. So your risk really is portfolio risk, not on that underlying individual loan. So key to this slide, when you place a term investment order, if the loan is clean, i.e. it's got no credit events and the interest rates as we say on the website, then you will automatically be matched and your investment will start. If it's had a credit event, then it will match and it will notify you to make a decision to accept or decline. All right, so here's what those screens look like, and I'll just talk you through that experience. So first of all, you've placed an order, and then when it's matched inside that 60 seconds, you may have been made an offer to accept or decline. So you can see where that orange arrow is, points to the accept or decline offers. So if you click into that order, you're going to be presented with a screen that looks like this, and you may find there could be more than one thing that is matched that you need to make a decision on, or there may only be one, and you may have other investments that have been made along the way. So you'll see a screen like that. If you click on the accept or decline button, it will take you through to this screen here. So for this particular example, you can see that the offer that you've been made is for an investment that has missed one payment. It's never been in arrears. So that's where the orange arrow is. So you can see it's missed one payment. It's never been in arrears, so no days in arrears. It's never been in hardship, and it's not currently in arrears. So why might a borrower have missed a payment, and why am I being presented with this? I guess that's the obvious question. So let me answer that one. So first of all, borrowers do miss payments from time to time. If you've been a borrower yourself at some point in the past, you may well have missed a payment, and it could be purely an administrative issue where you forgot to make sure the money was in the right account at the right time, which is the most common thing that we see. Or it could be that there was something slightly more deep-seated. You were having cash flow issues, whether for a short period or a longer period, and that may cause you to miss payments. Arrears will only show once a payment has been missed and hasn't been caught up on within 30 days. Okay, so for this particular loan, the borrower has missed a payment, but they've caught up on it inside 30 days. So in this situation, or in all of these situations, you've still got the backing of the reserve fund. It's up to you to decide whether to accept or decline, remembering that your risk here is portfolio risk, not on the individual loan. All right, so this is where you can make a decision. If you click accept, then that investment will match and your investment has started. If you decline, your order will automatically match within the next 60 seconds to the next available investment for you. The next available investment is all runs through our secondary market. So it could be a new loan or new to market loan that Squirrel is offering, or it could be an investor who is attempting to sell via the secondary market that you're matching to. Portfolio risk is at play, backing of the reserve funds in play. On the Squirrel website, on the marketplace page, so if you go to the Save and Invest part of Squirrel's website, on the marketplace, so if you click on that on the menu, you will see an image that looks like this, which shows you the size of our active loan portfolios, shows you the amount of money that is in each of our reserve funds, and also shows you what the expected default rates are for each of those portfolios, And last but not least, shows you the amount that we're reserving against each of those portfolios. So I'll just contrast those last two columns. First one is the borrower default rate. So that's what we expect potential loan defaults to be over time. And the column on the right shows you how much we're reserving against each of the portfolios. I talked earlier in the presentation or earlier in the webinar about the fact that our personal loans reserve fund has become very mature. So we are simply reserving at the same level of risk in the portfolio. For home loans, you can see portfolio risk is at 3 basis points, and we're reserving at 26 basis points, taking a conservative approach. And same for construction loans, risk in the portfolio, 33 basis points, reserving at 109 basis points. So that gives you a good indication of the health of the overall loan books and where we're at today. All right. First couple of questions are starting to come in. So I'm going to stop talking on some of the pre-prepared material and head to Q&A. So first of all, question from Neil, notifications can be a nuisance at times. Can I turn them off? The answer is today, no, Neil, but we are working on a new feature, which we expect to roll out over the next probably 3 to 4 months from now, which will allow you to manage those notifications in a much more refined way. So you'll be able to decide what notifications you want and which ones you don't want, just as importantly. So that's, it's a feature that we're working on now, but we don't have that in place just yet. Thanks for that question, Neil. All right. Next question is, do you predict further OCR increase in the next few months? When do you expect RBNZ decreases in the OCR? All right, so crystal ball time. If I look at what the market, so if I look at what the wholesale market is pricing in, no further OCR increases, okay? So we've seen quite a move over the last probably 4 weeks, where the market still seemed to think there might be another OCR increase. Now that is very much turned around. No further OCR increases are expected by the wholesale markets, and wholesale markets tend to give you a reasonable answer over time, and they're very responsive to economic data as it rolls through. Second part of the question: when might the RBNZ decrease the official cash rate? So once again, if I look at what wholesale markets are pricing, they would suggest that the first potential cut to an OCR would happen at the RBNZ's July meeting in 2024. So we're about 7-8 months away from that at this point. Thank you for that question. Of course, we should say, this isn't a forecast. It's simply what does the wholesale market think is going to happen at this point. If you look slightly further ahead, by the time we get to Christmas next year, the market says there's going to be 2 or 3 cuts to the official cash rate. So that's what the market's pricing. Whether we believe that or not, that's up to you to decide. My view would be, based on some of the economic data that we're starting to see, that the chance of the OCR being cut next year is high. How many cuts? Open to interpretation. And when might it happen? Open to interpretation. But certainly there's pain in the economy right now, which is starting to come through in the data very clearly. All right, next question. The app is okay, but still will not let me change to the amount I want to invest in an order. It still defaults to the balance of the current account. This will change in January. So happy to say that that particular issue, our mobile app gets a massive overhaul, which will land for you in mid to late January. So yeah, you'll see a far better and simpler user experience, I think, from the app. The apps have served us well, but they're about to get a significant overhaul, and I believe will deliver a far better experience for you. Just by way of insight, there's a bunch of people within Squirrel who are already using that new version and way prefer the new version that's coming for you. So We're just tidying up a few bits and pieces, and that'll roll out after Christmas. Thanks for that question. Almost think someone might have seeded that one for me. Next question from Paul. Do you foresee the current economic climate affecting the risk profiles? Paul, once again, I need to, brush off my crystal ball on that one. Right now, we're really comfortable with where the portfolio's at. We've seen over the last 12 to 14 months, house prices fall 20%. And from what we've seen, our portfolios have not suffered in an arrears sense at all during that period. In fact, I can show you some information that I prepared earlier. So maybe I'll flip to that slide and talk to that in a bit more detail. So on this slide here, you can see Squirrel's home loan portfolio, our construction loan portfolio, and our personal loan portfolio. For home loan and construction loans, you can see that we have currently no loans in arrears, so as at the end of October, and you can see that profile obviously running back all the way to March 2020. So no loans in arrears. For home loans, none over term, and certainly none in hardship at this point, and no expectations of seeing any particular issues in that portfolio in the foreseeable future. For our construction loan portfolio, we always seem to have a loan or two that are over term. And the reason for that is that often projects get delayed. Now, clearly during that COVID period, we were seeing projects delayed on a fairly regular basis. In more recent times, we have seen councils being quite slow. So it's taking longer to get titles out. Some of the consenting processes are still taking a really long time, and that's also impacting on projects. So at any given time, there seems to be a handful of loans that might be over term in our construction loan portfolio, and it's project delays. What we're not seeing is particular arrears. Okay, so there's around about 100 or over 100 loans in that portfolio, and the fact that we've had one or two go into arrears at various times means it's actually a relatively small proportion. So in the foreseeable future, I don't see any particular issues for the home loan portfolio or the construction loan portfolio. And that's also backed with the fact that the reserve fund is in place, or reserve funds are in place and doing a good job for investors to manage things when when a borrower does miss a payment. Personal loans are slightly different. So personal loans is always some loans in arrears, it would seem. This is a profile going back to March 2019. I could take it back further, but it tells a similar story. So at the moment for personal loans, there's about 3% of the loans in the portfolio by dollar value that are in arrears. The market for personal loans, so that Centrix just sent through some data. It arrived on my desk at 11:30 this morning, which says the market for personal loan arrears is over 9%. So our portfolio is at 3%. Now, I've talked previously about the fact that we have reduced the amount of risk that we were taking in that personal loan portfolio, and that's playing through quite nicely. So when we're a third of the level of the market for personal loans, that portfolio also is in a great state, both from a loan health perspective, and the reserve fund is very healthy. So no particular concerns on that front. One thing for the personal loan portfolio that I keep a pretty close eye on is the unemployment rate. So that's the portfolio that's most likely to be impacted by people losing jobs. So we'll keep a pretty close eye on that. But right now, reserve fund's really healthy, so no particular underlying concerns. Thanks for that question, Paul. Next question from Rory. With an OCR probably dropping, how long does it take to flow through to your cash account interest rate? So for our on-call interest rate, that's not tied to the official cash rate, but is, we'll call it, likely to track it over time. Okay, so it's not specifically tied to the official cash rate, and the rate could vary outside of moves from the official cash rate. In the foreseeable future, it'll probably move roughly in line with where the official cash rate goes. The reason I'm being cautious with the words that I use there, Rory, is the deposit compensation scheme, which the Reserve Bank is looking to roll out and be in place by the end of next year may cause some changes in that space, and we'll keep a pretty close eye on that. That's not likely to happen until late next year and too early really to pass too many comments on that. However, so the on-call interest rate's not explicitly linked with the official cash rate. However, it's likely to move broadly in line with that official cash rate. So let's say that first cut in the official cash rate is 25 basis points and happens in July, which is what the wholesale markets are predicting. It's likely that we would reduce our on-call rate by about that amount around about that time. We're likely to be quite responsive. So the bank that we earn interest from for those deposits, they make that change effective the day after an official cash rate change. So it's likely that we would also pass that on that same day. Thanks, Rory. Question from Darius. What's your prediction on new house builds in the next 12 months? Oh, there's a tough one to answer. So what we're seeing from developers, so clearly we're in touch with a lot of developers, courtesy of our construction loan portfolio and courtesy of our Squirrel mortgage advisors, who also settle loans with other financiers around the place. What we're seeing is investors are being cautious. We're seeing projects that are being delayed or might not be as strongly profitable as the developer would like before they take the risk. However, a lot more people have flooded into New Zealand over the last 12 months, as you saw in that graph earlier in the presentation. So are we likely to see more house building start to kick into gear? I would say it's going to have to, simply to house the population that we have. So I believe that we'll start seeing an increase in consenting again during the course of next year. At the moment, builders are still reasonably well employed. There's still quite a bit of activity going on, but the level of consenting that's been taking place over the last 6, 9, 12 months has definitely dropped, which means you're going to see less houses coming to market next year during 2024. But there are some signs that some developers are kicking back into gear and starting to try and get projects moving again at the moment. Not all will or can, but some are. So I think we're going to see a slump in the number of new homes available during the course of the next 12 months. Beyond that, then I'd expect that maybe we start to see a pickup in new homes being available again. Thanks, Darius. All right, next question from Martin. Will withdrawals change from overnight processing to nearest banking hour at any point in the foreseeable future with Squirrel? So, Martin, it probably depends which bank you're with. Today, Squirrel sends withdrawals back to our bank to process every 30 minutes from 9 a.m. through to 11 p.m. each night. So if you're finding that withdrawals don't arrive until overnight, it's likely that it's your bank that is slowing it down. So if I just give you an example, if you make a withdrawal at 9:45 a.m., 7 days a week, it should be back in your bank account for all the major banks within 2 hours. Squirrel will have sent that file off to our bank at just after 10 a.m. So 9:45 a.m. you make your withdrawal. We'll send that withdrawal over to our bank at just after 10 a.m. and should be back in your bank account within 2 hours for most of the major banks. There are some banks, so Heartland Bank would be an example where I believe there's still overnight processing. So if you happen to bank with Heartland, you make a withdrawal back to your Heartland account at 9:45 a.m. from Squirrel, you may not see that money until overnight from Heartland. Squirrel can't speed that up. We're going about as fast as we can make the banking system go. So at the moment, we're going as fast as we can go, and it's the banking system that will slow it down. For most of the major banks, or for all of the major banks, you'll see that money in your account normally within a couple of hours. And that's between the hours of 9 a.m. and about 11 p.m. each night. Thanks for the question, Martin. Feel free, if I didn't quite answer what you were looking for, please drop another question in. All right, next question from Dave. Do you think the amount of reserve fund levy for construction loans would decrease in the future, and have you passed that on to investors? For that portfolio, we are very conservatively reserving, and I think that's been prudent through the environment we've been through over the last 12 months or so. That reserve fund is building up quite nicely. So there's about 1.3, 1.4 million in that reserve fund now. And we've reduced the amount of risk in that portfolio. I suspect we'll be talking with our board, who govern that on behalf of investors, during the middle of next year. So if we were to drop reserving at that point, then investors would see an increase in the interest rate relative to what they have today. So it's possible, Dave. I'm certainly not making any promises. I've talked about the fact that we're very conservatively reserving. That may change during the course of next year. And not to say we won't be conservative, but given we've de-risked or reduced the amount of risk in the portfolio, and that buffer that would have built up in the reserve fund will be starting to get pretty nice at that point, then there may be scope for that to occur in the same way that we've done that for personal loans. However, that's a piece of string, which I don't know where the end of that is, Dave. So it's something we keep a good close eye on. In the foreseeable future, so the next, let's say, 3 or 4 months, I don't expect anything to change, but we do keep it under watch. The soonest I believe something might change would be the middle of next year. That would be my guess. Thanks, Dave. All right, next question. Are there any planned policies from the new government that you feel could have a major impact on the business, on the Squirrel business? I'll assume that you're meaning the Squirrel business and our loan portfolios. The government policies are looking to try and encourage more property investment, you'd have to say, based on rolling back some of the things that the Labor government had put in place. So that's probably a positive thing for the housing market, generally speaking. They've been silent on whether they continue to want to see the deposit compensation scheme come in. I think that's going to shuffle the market around a bit towards the end of next year. So they've been silent on that, to my knowledge, at this point. Other things, no, nothing particular. I'd say there's probably a bias for positivity towards the housing market, which would be positive for Squirrel, the company, and Squirrel, the loan portfolio. But based on the economic environment we're in right now, that probably counters anything that the government's doing, particularly. So pretty broad and open question, that one, but nothing on the horizon that I see would make any particular change for Squirrel, the business, or Squirrel, the lender and asset manager for investments. Thank you for that question. All right. Do you see supply chain issues persisting in the construction market? Broadly speaking, I'll say no. I think they're going to start, they are evening out as it stands. Shipping capacity, there is shipping capacity for goods that are coming in from offshore. And some of the capacity constraints that existed for New Zealand manufacturers of building and construction material have certainly eased. There's a lot of new homes that have been coming onto the market over the last 6 months or so as projects are finishing. So you'd expect, if anything, that some of those suppliers of building material and construction or support the construction industry, their capacity is improving right now, I would suggest. And that was evident in that second graph that I showed you today, looking at the amount of production that's going on in New Zealand. So that's my answer there, Dolph. Thank you for that. All right, questions seem to have largely dried up now. I think I might have had one more slide that I'm happy to show you, which I'll pop in and just give you a chance for any other questions to come through. So in this slide here, this is, I'll call it hot off my desktop. So email from Centrix this morning with their monthly update on what's going on across credit markets. So this shows at a market level what's going on with home loan arrears, credit card and car loans. personal loans and buy now, pay later, and also for telcos and utilities. So pretty much across the board, you've seen arrears come off lows through the COVID period, and they're trending back to what we might consider to be normal type levels. The interesting observation that I have for this one is if you look at the top right graph and you look at auto loans, you can see if you look at that grey line over time, you can see that it had quite a consistent, reliable seasonal pattern to what was happening for loans for cars. And then we go through COVID, everything got way, way better. But since interest rates started rising, you're seeing that line go in quite a jumpy movement. And I think what you're collectively seeing there is New Zealand's approach to belt tightening. So as all of a sudden there's a bit less cash floating around in the wallet each month. It's just to cinch up that belt by a notch, cinch it up, cinch it up, cinch it up. And you're seeing Kiwis reacting to the fact that interest rates are going up. They've got less cash available to them. Obviously, inflation underlying all of that's making it harder to have that cash available to pay loans. I think you can see exactly that same trend in the bottom right graph for telcos. So you can see reasonably reliable, consistent sort of trend. Then all of a sudden you see a very jagged approach to things as inflation started ticking up and then interest rates started ticking up. So there's collective belt tightening going on across the New Zealand economy like we haven't seen for an awfully long time, would be my view on it. If you look at the top left graph, you can see from a housing perspective, home loan arrears back to about where they were at their low points from a seasonal perspective going back pre-COVID. So is there anything to be particularly concerned about for home loans? No. And remembering this is market for all 250 billion of home loans out there. Nothing particularly, but the thing I'd keep a really close eye on here is the unemployment rate. So if that was to rise quickly, then you may see an increase in arrears or further arrears in that home loan arrears graph from Centrix. Question from Nigel: lending crowd is closing down as it's not viable. Is that a risk for Squirrel? The answer, Nigel, is no. So the Squirrel Money business is viable and profitable and growing very nicely, thanks. If we look at what lending crowd did, they focused only on that personal loan market. For Squirrel ourselves, we've found that personal loan market, we can't grow it as fast as what investors would like to invest in it. So that's been a perennial problem for us, where we've always had more investor demand than we've been able to stimulate loans. So from Squirrel's perspective, our home loan and construction loans, we can originate a lot of loans in that space. So if you're investing in home loan or construction loan term investments, you'll find you pretty much match straight away. It would be very rare for us not to have something for you to invest into. And typically that might be on a weekend where we catch ourselves out, where their investors come along and they invest a whole lot more than what we expected during the course of Saturday and Sunday. And if we're not keeping an eye on it, we might not have fed the next loan in. If that happens to occur, chances are as soon as we see that situation, we'll fire a new loan in and you'll start matching straight away at that point. Sometimes you'll find when a loan matures, investors start reinvesting straight away and they can chew through any loans that are on the secondary market and any new loans that Squirrel is passing on really quickly. So we might have brief gaps, for an hour or something like that while we're just letting things move through before we pop the next loan up for people to invest into. So in answer to your question, Nigel, I see no issues on the viability of Squirrel Money. It's a profitable part of our business and growing really strongly. So really happy to say happy days, no issues on that front for us. Thanks, Nigel. Next question, different Nigel this time. Is there any data on the demographics of the migrants coming in? Are they skewed older or boomer? Good question. I don't have data. Perhaps Stats New Zealand might have the data. I haven't gone looking for it, so I'm not sure I can answer that one particularly. We do know that there were various pressures in different parts of our workforce during the course of last year that has started to ease somewhat. So nursing, bus drivers would be two that I can roll off the top of my head. But we're seeing migrants come in across those demographics. Is there a skew though? I'm sorry, I can't answer that. Maybe if we have a look at Stats New Zealand, they might be able to give us some data there. And maybe I'll go and have a look and see if I can answer that question at some point in the future. Thanks, Nigel. Next question from John. I asked for buckets or multiple on-call accounts at the start. Can't wait for it. So thanks, John. Yep, I expect by the time we get to March, as I said, the design work's just about completed now for those multiple on-call accounts. So yeah, we're well on the case for that one. Thanks, John. Next question from Nigel. Would Squirrel consider taking over any of the lending crowd loans? Oh, is a difficult one. I guess the challenge with doing something like that, Nigel, would be we would have to then consider the credit risk that those loans have been written with, because it would be our reserve funds that are effectively backing those loans in that situation. So that sounds like a difficult proposition. It would require an awful lot of due diligence on Squirrel's behalf to do that. So at face value, I'd probably say no, Nigel. Famous last words, someone might knock on the door tomorrow and who knows what might happen. But there is certainly no signs of us doing anything like that. And we would be incredibly careful. We trust our own credit processes. We know what we're good at and we know what we've written. When you're taking on or buying someone else's loan book, you'd have to ask yourself the question of whether you know where the skeletons are buried, so to speak. So we know what we've done, what others have done. It's harder to gauge. So hopefully that answers your question, Nigel. Thank you for that one. Question here, in your opinion, have the term investment rates peaked? Okay, so opinion, crystal ball, all those sorts of things. My view would be yes. So if you look at the way that the wholesale market is pricing things at the moment, you would say absolutely interest rates have peaked. Based on the economic conditions and assuming no shocks in some positive way or some negative way, in some way, shape, or form. So yes, have interest rates peaked? In my view, clearly yes. What does that mean for term investment rates? So bank term investment rates, I would say those longer term investment rates are probably going to start to fall a little bit. Probably not until after Christmas though. I would say they'll hold things off until then. 1 year term deposits are probably at their peak with a bank right now. For Squirrel, I don't see us changing our interest rates in the foreseeable future. So the next 3, 4, 5 months, assuming no particular shocks, I don't see us changing those rates. Clearly, if a shock comes through, then all bets are off. But I would say yes, term investment rates have peaked. Thanks for that question. Question from Nick, is the secondary market working for construction loans or is it just running a bit slow currently? What we've found is we've seen quite a few investors who have placed investments on the secondary market. It looks like we've got quite a few first home buyers who look like they might be buying homes at the moment. So they're cashing up their deposits and getting themselves ready. So there's definitely a bit of that going on in there at the moment, Nick. We've also had very few loans maturing this month. So often it's maturing loans that cause the secondary market to take over really quickly. There's been very few of those happening in the last 3 or 4 weeks. What we do know though is there's quite a number coming up to maturity towards the end of this week that I'm aware of, and a few more during the course of December. So it feels like it's been a bit slow just of late, and it's taking maybe a day or a few days for people to sell on the secondary market. I suspect you'll see that come back during the course of December as we get back into a more normal rhythm of loans maturing. Often it's loans maturing that cause a lot more investment activity on the day. On the market page, before I finish with that question, Nick, on the marketplace page on Squirrel's website, so if you go to the Squirrel website, squirrel.co.nz, go to the Save and Invest tab, and in the menu that drops down there, if you go to the marketplace, in there is a little table that shows you how much is turning over through that secondary market for each of our different types of term investments over the last 7 days. So Nick, that's a good place to go and have a look and see how much is actually running through the market at any given time. Thanks for that question, Nick. All right, next one. What is a 1 year swap? So let's start with that. Looks like there's 2 questions here, so thanks, Richard, for those. First one is, what is a one-year swap? So that's an indication. It's probably technical language and more technical than I should be using. It gives you an indication of the way banks trade between themselves on a particular term. So this is wholesale interest rates rather than retail. It's not something that a retail investor can buy or sell particularly, but it's banks effectively trading between themselves on a one-year term, if that makes sense. So someone's taking on one side of that transaction and another wholesale investor is taking on the other side of that transaction. Second part of the question is, what is the on-call interest rate at present? So Squirrel's on-call interest rate, I'm assuming that that's what you mean in there, Richard, is 5.25% per annum. That's relative to the official cash rate at 5.25% per annum. We think that's still, if not the highest, almost the highest interest rate you'll get for on-call money in the market with no strings attached. So often you'll see others out there with a rate that might be the similar or higher, but it will have some strings attached. So it might be a 30-day notice period, for example, or if it's a bonus saver product, you might have to, you may not be allowed to make any withdrawals, or it'll have fees. Squirrel, it's a very clean product in that you earn interest. There's no conditions on earning that interest. There are no fees. So from that perspective, I think it's a pretty good proposition in the marketplace right now. Thanks for those two questions, Richard. Okay, you guys are doing great with your questions. Keep them going. I think I got to about somewhere between 20 and 25 at the lunchtime session. Next question from Kirsten. Last screen just showed two interest rates, 7.5% and 7.75%. Just wondering why the two rates are different. So let's go back to that and we will have a look at it. So on here. All right, so there's actually two things that are different about this investment for investors. And this is, to be clear, this is a personal loan term investment. Our personal loan term investments have fixed interest rates. Okay, so that means when you invest at a particular rate and that interest rate is locked in for the term of that investment. So this particular investor has invested at 7.50% for this loan. The prevailing interest rate for the 5 to 7 year personal loan term today is 7.75. So you, as the investor who's been offered this investment, if you take it on, you're going to be earning 7.5%. The prevailing interest rate for the 5 to 7 year personal loan term bucket is 7.75%. Okay, so if you take it, it means you're going to get invested today rather than waiting longer for a new loan to arrive or a clean secondary market loan to arrive. Yeah, so that's the difference. So it means that the investment that you're going to take this interest rate at would be 7.5 if you choose to accept. Thanks for that question, Kirsten, and that was very eagle-eyed of you to spot that one. Thank you. All right, next question from Jonathan. Can you see a page that shows the basics, please, i.e. total investments, growth, current value? On our website, I don't think we show you growth or how things are moving. We show you current value. So if you go to the, once again, the marketplace page, so save and investments menu on Squirrel's website, and you go to the marketplace page, it will show you a table that looks like this. So on this table, you can see the size of each of the portfolios. So personal loans is 12 million, home loans 24 million, construction loans 88 million. You can see the size of the reserve funds, coverage ratio, which tells you the size of the reserve fund relative to the portfolio. It also shows you the expected or modeled borrower default rate for each of the three portfolios. And I showed you that line graph of how that had changed over time. And then you, in the very final column, it shows you the amount of money or percentage that we're reserving against, on average, against each of those loans over time. So that money is what's going in to the reserve funds and making sure there's money there to manage any of those expected defaults. So we tend to reserve quite conservatively. So for home loans and construction loans, you can see the amount of risk at 3 basis points and 33 basis points respectively, and we're reserving at 26 basis points and 109 basis points respectively. So reserving conservatively. For personal loans, you'll see those last two numbers there at 0.86 and 0.85. Because the reserve fund is very mature relative to the size of that portfolio, it's allowed us to bring the reserving down and bump up investor interest rates. So that gives you a sense of that table. So, Jonathan, I hope that answers your question. We may consider putting something else on the website that shows you portfolio growth over time. I think I see where you're getting back there. But certainly this information gives you a sense of the total size of those portfolios today. Thanks for that question, Jonathan. Question from Peter. Swap rate. So that's the wholesale. So what does the swap rate mean? Once again, I'm getting into technical jargon that I probably shouldn't have used, so my apologies for that, Peter. What we're basically talking about there is wholesale interest rates. So that's banks trading between themselves, broadly speaking. And I'll leave that one at that. Thanks, Peter. And reminder to self not to talk about swap rates in the future and just talk wholesale interest rates. Thank you. Question from Ruth. We're new to Squirrel and have some money to lend. What documentation do you provide for us to assess loans? Good question. Thanks, Ruth. So at Squirrel, Ruth, we provide reserve funds, which mean that when you're assessing how to invest in our term investments, you're looking at the underlying risk of a portfolio rather than looking at individual loans. Okay, so we know with other peer-to-peer lenders, when you go and invest with them, they'll present you with a range of loans and you're going to choose to invest in some of them, and you'll need to manage your own diversification. So that means you're going to say, hey, I'm going to spread my investments across a few loans to make sure that if one goes bad, I'm not losing all of my principal at one time. Squirrel takes a different approach. So what we do is we manage three different portfolios as it is today. So personal loan term investments, home loan term investments, and construction loan term investments. The underlying level of risk we provide investors, and the table that you see on the slide that's in front of you now gives you an indication of that risk. So that's the fourth column across. That's the level of risk in each of those portfolios. And if you look at the Squirrel Investor Handbook, which you can find on our website, that goes into more detail about each of these loan classes. So it talks about the loan to value ratio that we'll go to for home loans and construction loans, which has to be less than 80%. There's a whole lot of other rules and things that we put in place to make sure that we've got some diversification there in what we do. And key thing to managing the credit risk is then the reserve funds. So the reserve funds help spread, or for our investors, regardless of which loan or loans you're invested into, you effectively have portfolio risk. So the reserve funds help manages that for you. So if a particular loan that you're invested in goes into arrears or into default, it's the reserve fund that stumps up, assuming it has funds, of course, to manage that credit risk for you. So, in simple answer to your question, Ruth, is we don't provide you documentation on individual loans. We provide you the specifications of the overall pool of loans that you choose to invest into. So if you're a more conservative investor, you're more likely to invest in home loans. If you're looking for a bit more risk, then you'll step up either to construction loans or personal loans. Hope that answers your question, Ruth. Happy to take more. Feel free to hit me up on dave@squirrel.co.nz if you would like more information on that. Thank you for that one. Next question from Nigel. What's the average investor balance on the Squirrel platform? It's around, for a retail investor, it's around about $30,000, give or take. That number varies from investors who have $100 in a term investment all the way up to investors who hold millions with us. So there's quite a wide range. The average, though, at the moment is about 25,000. Yeah, so it gives you a good indication of where we're up to. In total, from our investors, there's around about $140 million invested from investors on the Squirrel platform. And that's some of those have come through our managed funds, some of them in our term investments directly. On top of that 140 million, there's about another 100 million in the on-call account. So yeah, we don't hide that information. We're really transparent with it, and you'll see us disclose those numbers, broadly speaking, on the marketplace page on our website. So if you add up the three numbers in the leftmost column on the slide that you see in front of you at the moment, you'll get to the numbers that I spoke to for our term investments. And on top of that, there's about another 100 million in the on-call account. And you can find that information, which is updated regularly, or daily at least, on the marketplace page on the Squirrel website. Thanks, Nigel. Next question from Niraj. When I try to refer my friends to Squirrel, they seem to be skeptical about its reliability and transparency. What can we do to advertise Squirrel as a safe and reliable investment platform? Thank you, Niraj. I appreciate you referring your friends to Squirrel. I think trust is something that's built over time. And, the thing that prevents most people is they believe that what we're doing is high risk. And, compared to a bank, it is riskier. So let's make no bones of that. However, we believe we've got the right safeguards in place, the use of things like the reserve funds, for example, to help manage those risks for investors. Banks are enormous organizations. If you look at ANZ, they've probably got more than $100 billion of home loans in their portfolio right now. For Squirrel, we're still growing. I talked about the fact that, we've got a loan book that's approaching 160 million at the moment. So we're smaller as a consequence of that relative to those big banks. So there are some more risks. However, investors earn higher returns for that additional piece of risk. I talked about our home loan portfolio at the moment. Actually, the underlying credit risk is actually similar to a bank. It's sort of similar levels to what a bank would be running. It's not particularly out of line there, but there is definitely more risk for construction loans and a big step up again then for personal loans and the underlying risk. So from a transparency perspective, I think the marketplace page gives a really clear view of what we do and how we do it. And as far as reliability goes, well, I think you can let your friends know how reliable we are based on your experience. The other thing they can do is they can always chat to us. So if you go to the main Save and Invest page at Squirrel, there's an opportunity there to book a meeting with either me or Doug Thompson, who's our investor relations manager, and we'll spend time chatting with them about their concerns and the risks, and make sure that they feel comfortable either to invest or they may choose not to. But yeah, that's a good way to get some one-on-one time either with myself or with Doug Thompson. So head to the main Save and Invest page on the Squirrel website, and you can book time with one of us to do exactly that from there. That'll book it into your calendar and our calendar, and we'll give you a call and talk your friends through it. But really appreciate you chatting and being a referrer of Squirrel, Niraj. Really appreciate that. Thank you. Question from Michelle, will you ever have PI interest? Well, interestingly, Michelle, we already have PI interest today for our managed funds. So Squirrel has the Squirrel Monthly Income Fund in place that invests into our home loan and construction loan term investments. And the underlying tax is PI tax rather than resident withholding tax in our home loan term investments and construction loan term investments. So that's available today, Michelle. If you'd like to chat about that, you once again book some time, like I just described in the last question on the main Save and Invest page, and more than happy to talk you through what we do around our managed funds. There's also a page on our website that talks about the Squirrel Monthly Income Fund. And yeah, what we don't have today is PI tax-based product for our on-call account. It's something we've been thinking about. If any of you listening today are interested in that side of it, feel free to send me some feedback on dave@squirrel.co.nz. Thanks, Michelle. All righty, next question. I understand Squirrel is a peer-to-peer platform, but thinking about on-call account, are there any future plans to introduce a card feature within the on-call account? At this stage, the answer to that is no. Introducing a card feature is a significant step up operationally, and we're not sure whether we want to step in that direction. We think we're really good at managing loans and managing investors. The operational disciplines, when you move into that card space, come with all sorts of additional complications. We're not sure we're quite ready for that yet. Might we do it at some point in the future? We might do, but there's certainly no current plans to do that. Thank you for your question, though. Right, next question from Jonathan. Thanks, but I meant my personal account figures. Jonathan, let me just go back to the question that you asked. Bear with me just a second. Oh, total investments growth and current value. Yeah, so you should be able to see that today if you log in via desktop or browser. When you log in to the mobile apps, the reporting suite is not as good. Okay, so our mobile reporting suite today is not as good as what it is if you log in through desktop. There's lots of information if you look in through desktop. And I believe that that's going to get even better when we roll out the new screen. So log in through desktop next week. Let me know what you think, Jonathan. And then when we roll it out to mobile, which should be mid-January, you should see some significant improvements in the reporting that's available to you there. So sorry for misconstruing your question there, Jonathan, but hopefully I've answered that now. Thank you for that one. Last one on the list at this point is the personal loans interest rate. Didn't it recently decrease from 8 to 7.75? You mentioned the interest rate was recently bumped up for investors. So what's happened there, Kirsten, is the prevailing interest rate, so the interest rate for brand new investments coming through, has dropped from 8% to 7.75. All existing investments got bumped up at the same time that we made that change. So if you had previously invested in a personal loan and managed to snag an 8% loan or 8% investment, that investment today will be 8.25%. For all new ones coming through, in our attempt to try and drive greater volume, we've lowered our lending rates and lowered our investment rate down to 7.75%. Hopefully that answers your question there, Kirsten, and that's a good one. So thank you for that. Next question from Richard. Have you complied with the FMA requirement for an independent review? Absolutely, we have. So if any of you Google Squirrel and our term investments, you'll see that the FMA gave us a warning about not having provided a custodial report. This goes back a number of years ago now. We didn't realize that that was a requirement. Basically, our compliance let us down there where we missed that we needed to provide a custodial review of our portfolio each year to the FMA. When we found out that that was required, we complied immediately, had a report completed, and we've provided that to the FMA every year since. So yeah, there was a lapse on our part in missing that it was a requirement. Those reviews are completed annually. They've not uncovered any issues, so they're effectively clean audits from a custodial perspective. Those reports are provided through to the FMA each year. And I think they're on the Disclose website as well. So if you want to go hunting on there, you're more than welcome to go and have a look at those reports from KPMG, who are our auditors and conduct both the financial audit of Squirrel and the custodial audit of Squirrel. And that's done on an annual basis. So simple answer to your question, Richard, is yes. And I gave you a much longer spiel in behind that one. If you have further questions, feel free, dave@squirrel.co.nz. Another question from Niraj. Would you have any provision to provide subsidized lending rates if we have investments with Squirrel? Typically, the answer to that is no, Niraj. And the reason is, unless you can find an investor who's prepared to offer a subsidized investment rate. So if you're aware of some investors who have a whole lot of money to lend to people and they only want a return of 1% and they're prepared for us to lend it at a lower rate, then we'd be prepared to look at it for sure. But what we find is investors are trying to maximize their interest, borrowers are trying to minimize, and we've got to try and find a way through that in the middle. If we can't provide interest rates that attract investments from investors, then we can't write loans to help out the borrowers that we help out. So yeah, there's a delicate balance there between those two things, Niraj. Thank you for that question. All right. Thank you very much, team. That brings us to the end of the webinar. No further questions have come on. Great set of questions, by the way. So if you're still there, thanks for asking all those questions along the way. If you have other feedback for me on the content in this webinar or other things you'd like to hear about, do feel free to touch base on dave@squirrel.co.nz. Thanks very much. Catch you soon.